Good morning. My name is Scott Redler, Chief Strategic Officer at T3Live.com. I'm going to do a quick little Apple update. Over the course of the past 2 months, I've been trying to do some specific Apple strategy videos to try and keep investors out of harm's way, traders with a tactical plan to approach it. And as we come in today after earnings, there's a whole way of going about it. Now, the reports behind us, you've heard all the numbers. Some people think, oh my goodness, it was still great. Who are those analysts to put those expectations so high? Fundamentally, it's undervalued. They have a ton of cash. All these things are well and good, but the price action is the price action. And if you take a quick look at the chart, you will see, starting from that 703 top, which came in right around here, you had that short-term head and shoulders pattern. Here is when it broke the 21-day that it was actually riding for the majority of that nice swing move we saw back over the summer. And then this was a spot to be flexible. And you never really know where it's going to go, but you don't really have to if you try and get out of harm's way. And from there, the 21-day moving average, acted as resistance pretty much the entire way down. We broke the 50, we broke the 100, we then broke the 200, and then we did have some nice rallies that were tradable back to the trend line. But overall, the trend line kept controlling this tape. So lo and behold, yesterday you had earnings. The question was, would it be enough in order to change the character of Apple, get it back on track, break this descending trend line? You know what? It didn't. And everyone approaches the market in different ways. So if you come back to me, there's now a way to approach it after earnings. We've seen these types of reports. Sometimes they gap down, they gap up, and the gap tells us a lot about what the future direction is going to be. For me, I would say 99% of the time I don't take stock into earnings. As a trader, it's a good way to blow up your account. As a long-term investor, sometimes you have to, but hopefully you do it with a hedge. You go into an earnings report, you're really flipping a coin. And if you think you're not and you think you know something, you shouldn't be playing it because that's how you get in trouble. So the bottom line is, yesterday I thought, after a 200-point down move, I could go with the call spread. So I bought the 525, sold the 550s, and risked 5 to make 20. Good risk reward. It's a 0. I'm fine with it because it was calculated. Risk was premium paid. Now I come in fresh. I don't own the stock. I've been trading at a level versus a level, trying to figure it out during the way, typically from the long side, but also from the short side. And now the question is, what will it do today? It's opening down 50 points or so. Is it going to close down 60 and be really weak and continue perhaps in that direction over the next few weeks? Or does it, open down 50 and maybe close down 30 and maybe there's a trade in there? So you look at the chart right now where we are. Okay, this was the previous low, which we're already below. This is 483. The pre-market low or the after hours low yesterday was 457-ish. So right down 457. 457 was the low of after hours. See if it tests that. And then you have an area all the way down here at 443, which was a gap way back when. So with that in mind, you have to watch the action close. And I know for me, I'm going to let it put a pivot low in and then perhaps buy versus that pivot low, not a lot, and then see if it could build. See if it could actually trade off the lows and fill a portion of the gap. If it can't, I'm probably just going to get out of the way. Now, there were 2 other gaps in Apple that told a lot of the story, which I wanted to show you as an example. Okay, one being you go way back when. Let's take a look at the chart. You'll see here, if you remember, I know this was a long time ago, many moons ago, you had a gap up after earnings. Okay, it consolidated and you didn't have to do anything, and this gap up gave you the direction of the stock with the 8-day and the 21-day. And here was your buy. So you didn't have to buy it into earnings, and you were able to enter afterwards, risk averse, and still catch a nice run. Okay, then this one I think is a lot more important. Okay, if you guys remember way back when, right here, okay, about 2 quarters ago when they missed. Okay, they missed right here. Okay, came down, hovered, didn't give you much of a trade. Okay, within that day, the next day went sideways, but then it traded into the gap, which was right above, I think, that 580, and it filled it in 3 days, showing you that Apple was on sale. They didn't really care about this report. It was a buying opportunity. If it didn't fill this gap and continue to the downside, that gap would have controlled it. So that's what I'm going to be looking to see what happens with the Apple gap today. Okay, if we open down and don't fill the gap whatsoever, what happens in the next few days? Can we get a gap or a trade above the level to fill it? If we can't fill a major portion of the gap that gets created today, it's going to be a massive hole, and a massive hole, which means that no one wants it this down here. That's going to show you a lack of demand. And then unfortunately, for guys who are just sitting in it without a plan, that can mean, even a lot lower prices than this 443. So, for me, Apple has a lot to prove. I'm gonna, take a look to see if it's buyable on this gap down. I think it's not good to be pressing it short right here. You've made your money short. I think you're a little piggy if you try. Maybe you make a little, but it's a wait and see. Let's see the way it shakes out. But I would do a level versus a level, and then the next few days we'll figure out if there's something more we could do that could actually build a new trend, or if it's not even worth your time unless you're going to sit shorted and see if it can get down to the 403 or 380, which people are talking about. For me, still wait and see mode. It's still under pressure. It still has a lot to prove. It's unfortunate, but it's the way it is. And if you want to tune in to me on the radio, I'll be talking about it. I'll be looking at it on the virtual trading floor. You'll see whether or not I go from no position in Apple to it flashing green, and then you get to see how I trade it and if I hold it, or if even I get shorted if it doesn't show any signs of life. But hopefully I'll navigate you through it. And lately, I haven't even been enamored with it. There's been a lot of great action out there. Markets are rotating. Money's going elsewhere. So, sometimes you just have to, can't be an old dog. You have to be, a red dog and find a new trick. And there's been a lot of new tricks in the financials, the industrials, the transports. There's been a lot of great action, and you haven't had to be just focused on Apple. So let's hope it changes. If it doesn't, we'll move on. Have a great day trading. Scott Redler.